I'm cheating, actually, because I have two graphs. The interesting thing is to compare the two. On the left-hand side, you see that the risk-weighted assets of banks in all the major areas are trending downwards substantially, but they remain very different from each other. And on the right-hand side, when you look at the capital ratios, you find they're all the same. Why is that? Because the banks are very successful in gaming the system. That shows how difficult it's going to be for the regulators to get control over the banks on both sides of the Atlantic and indeed in the Pacific.
The US shale revolution and support for energy resource development has helped keep US energy prices well below European levels. This is contributing to a resurgence in US manufacturing competitiveness and investment, especially in energy-intensive areas. US manufacturing will capture $70 to $115 billion of annual exports from other countries by 2020. It should give Europe pause for thought on its energy policy and how it chooses to develop its energy resources.
This chart shows Germany's and China's external surpluses, the difference between what they save and invest. They're about the same in US dollar terms, but though China is usually seen as the arch mercantilist, Germany's surplus is now 3 times that of China in terms of GDP. Germany's economic model and behaviour is widely seen as incompatible with the stable Eurozone. If and how these two economic giants deal with the domestic imbalances behind these surpluses will have a significant impact on the rest of us in 2014.
This chart is actually a chart showing what's happened to output per head since the start of the recession and also since this government came into office. And what it shows is that output per head today is lower than it was in May 2010 when the coalition took office. So far from the government being vindicated, this actually shows the worst recovery in 100 years. And in fact, what it shows is no recovery at all. People are poorer today than they were when the government took office.
This chart shows economic forecasts for GDP for each year in the coloured lines and the actual outcome GDP in the pink blocks. The turning point for the UK economy was sort of the beginning of 2013, just when the doomsayers were really down on the UK. The other thing it shows you is the financial forecasting profession always underestimate amplitude. So the good years are much stronger than they ever predict, and the bad years are a lot worse. So this tells me that the UK economy has finally turned a corner, and it's probably growing a lot stronger than most predict.
10-year gilt yields tell the economic tale of the year quite well. Early in the year, the fear was that we were in triple-dip recession, the UK lost its AAA rating, and there was talk of more quantitative easing. But that more quantitative easing never quite happened, so the dip came to an end. The international environment improved, with the Fed signalling it might taper in 2014, and gilt yields rose dramatically through the middle of the year. The Bank of England thought the rise was unjustified and tried to stop it with forward guidance, but that failed. And as GDP growth resumed in the UK, with the good news continuing, the rising gilt yields resumed.
Through the 20th century, economic growth fed into successive generations having, on average, higher incomes. And this graph shows median incomes by age among those born in different decades. For example, if you're born in the 1960s or 1970s, then you were likely to enjoy more income at, say, age 30 than people who've been born in the past. But the really striking thing from the graph is that this is no longer the case. Those born in the 1960s and 1970s are no longer experiencing higher average incomes than previous generations did when they were the same age.